EduTap and welcome to the Finance 360 degree session. In this session, we are going to cover two very important news articles, and the first news article is regarding the Securities and Exchange Board of India that has released the guidelines, the amended guidelines for the securitized debt instruments, and this is somehow related to the Reserve Bank of India regulated entities also. So I've told you that if the SEBI news articles or if the SEBI guidelines are in news as well as they are related to the RBI or the regulated entities of RBI, so that news articles become much more important. Okay, so such news article, it can like the questions can come from this news article in the phase 1 of the examination as well as in the phase 2 of the examination. So we will understand that how the SEBI has released this guideline, why the SEBI has released this guideline, as well as how it is impacting the RBI regulated entities. Okay. The second news article is regarding the record profits that have been posted by the public sector banks. So we will discuss that what are these record profits, how the profits have increased, as well as we will discuss that which public sector bank has notified the highest profits in percentage terms and in amount terms. Okay, so these two news articles we are going to discuss in today's session, and let me tell you that both these news articles are very important from the objective part of the examination, and we will discuss these news articles in detail in today's session. Now let's start with the session. Give me a thumbs up if I am clearly audible and the screen is clearly visible. And do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So usually you get the PDF within 24 hours. Okay, but today is holiday for the team and that's why I think this PDF will be provided to you by Monday by the team. Okay. Now let's start with today's first news article, the first topic, where we will discuss about the Securities and Exchange Board of India that has mandated a minimum ticket size of the investment, or the minimum ticket size or investment threshold of rupees 1 crore. Now we will discuss this. We will discuss this news article. We will discuss about the ticket size and such. But first we have to understand about the securitized debt instruments, that what are these securitized debt instruments. Okay. So if you know about the securitization, or if you know about the securitized debt instruments, in this what happens, that let's say there is the lender, okay, that is giving multiple loans. The lender is giving the vehicle loans, the lender is giving the home loans, the lender is giving multiple types of loans. Now the lender has given the loans worth rupees 10 crore, let's say, in total. Now these loans are clubbed together, and they are turned into the investment product, into the financial product that is sold to the investors, This is the process. The lenders, they have given the loans. Now these loans are clubbed together, and these loans, after clubbing together, they become the investment product or the financial product that is sold to the investors. Now the lenders are getting the interest from the borrowers. Now this part of the interest is given to the investors. Okay, part of the interest is given to the investors. Let's say lenders are getting 12% of interest. So 10% of interest is given to the investors, let's say. Okay, so this is the idea. So investors, they invest in this investment product or financial product to get the returns, to get the interest and such. This is the idea about the process. Okay, now let's understand about the securitized debt instruments. These are the instruments, these are the financial products, or the investment products created by pooling together, clubbing together various type of debt, such as loans, mortgages, that is the home loans, or the receivables like the trade receivables. Okay, so I hope you know about the trade receivables. Let's say XYZ is the seller and ABC is the buyer. Now the buyer is buying the tables, chairs, or let's say the buyer is buying the big machineries, okay. So now the seller has sold the big machineries to the buyer, and the buyer has to pay 20 crore rupees. But the buyer is saying that I don't have 20 crore rupees right now. I will give the 20 crore rupees after 2 months. So give me the time of 2 months. Now the seller trusts the buyer. Okay, so the seller has agreed that okay, you can pay after 2 months. Okay, so this is a trade now the seller is sending a bill invoice to the buyer that after 2 months you will have to give me 20 crore rupees. So this bill invoice is the trade receivable of a kind that after 2 months the payment will be made to the seller. 20 crore rupees will be given to the seller. Okay. So such trade receivables can also, now these trade receivables is a kind of loan. It is what? It is a kind of loan to the buyer. That buyer will pay after 2 months. Okay. So buyer has got the product. Now it is a kind of loan to the buyer that buyer has to return, or the buyer has to pay the 20 crore rupees after 2 months. So this is a kind of loan or the receivable, we can say. That buyer will have to pay 20 crore rupees after 2 months. So this is the kind of liability of the buyer, we can say. So this is the liability of the buyer, that buyer has to pay 20 crore rupees after 2 months. So securitized debt instruments in this different kind of loans, mortgages, receivables are clubbed together, are pooled together, and these securitized debt instruments are then sold to the investors. These securitized debt instruments are then sold to the investors. Okay. Now, for this purpose, in India, there is a special process. For the securitization, there is a special process. So, in the securitization, what is happening? That the originator, that is the owner of the asset. Let's say the originator is a bank that has given the loans, the vehicle loans, the home loans, and such. So these loans are being clubbed together and they are sold to the special purpose entity. It is sold to the special purpose distinct entity. So the special purpose distinct entity means a trust. It is a trust, okay, which acquires the debt or the receivables out of the funds mobilized by it. So basically the special purpose entity, it is buying the debt and the receivables from the originator, from the bank, from the NBFC, or the originator can be the other entities also that we will discuss. But basically the special purpose entity buys the loans, buys the receivables, and then the special purpose entity is selling this pooled loans or the securitized debt instruments to the investors. Okay. So this is the process of the securitization. This is the process of the securitization, that the originators, they sell their debt or they sell their loans and the receivables to the special purpose entity, which in turn sell the pooled debt and the receivables to the investors, and the originators that are getting the interest from the borrowers, they transfer some returns to the investors. Okay. So this is the basic idea. So special purpose distinct entity means a trust which acquires the debt or receivables out of the funds. Now how the trust is buying these debt or is buying these receivables from the originator? By mobilizing the funds by issuing the securitized debt instruments through one or more schemes. So basically the special purpose entity is the middleman in between the originator and the investors. Directly the originator cannot create securities or the securitized debt instruments in our country. So originator sells their debt and the receivables in a bundle to the special purpose entity, which in the bundle which sells the securitized debt instruments to the investors. Getting the point? So this is the process of securitization in India. And the special purpose distinct entity, they are kind of middlemen that acquire the debt or receivables out of the funds mobilized by it by issuing the securities or the securitized debt instruments through one or more schemes, and includes any trust. So special purpose distinct entity can be any trust set up by the National Housing Bank or the National Bank for Agriculture and Rural Development. Okay. So this is the idea. Securitized debt instrument and the special purpose distinct entity. Is it clear? Are these clear? What is PTC? Mukund? Okay, originator. Now originator, whenever the originator or loan comes in your mind, which are the institutions that are involved? So whenever I think about the loans, the banks come in my mind, that okay, banks are giving the loans or the NBFCs are giving the loans. But when we talk about the originator, here we are also talking about the trade receivables. Here we are also talking about the trade receivables. As well as there is also the equipment leasing receivables. Okay. So here when we are talking about originators, we not only have to think about the banks and NBFCs, but here we also have to think about the real estate developers, the real estate developers, the corporates, and the equipment leasing firms. And there are various other entities also. Okay, so these are the originators. The real estate developers, let's say the real estate developer is selling a house of 10 crore. Okay, but the person that is buying the house is saying that I can only pay 2 crore right now. The 8 crore I will pay on a later on date after 2 months, let's say. So this 8 crore is the liability of the person to pay to the real estate developer. So this is also a kind of loan that the real estate developer has given, or this is a liability on the other person to pay to the real estate developer. Okay, so this is the idea. Now the equipment leasing firm has given the equipments, the big equipments on lease, and they are getting the money after a period of time. So that is also liability on the other party. Okay, so this is the basic idea. Now originator means the assigner of the debt or receivables to a special purpose distinct entity. So originator is the owner of the asset that is going to get the money later on, and they are assigning the debt or the receivables to the special purpose entity that will further sell the securitized debt instrument to the investor. Okay, so this is the idea. So originator means the assigner of the debt or receivables to a special purpose distinct entity for the purpose of securitization. The originator is the person that is assigning the debt or the receivables to the special purpose entity for securitization, for completing the securitization process. Okay, now the banks can also get involved in the trade receivables, or let's say there is a big corporate, there is a big entity that is selling the products, and this big entity is like many of the buyers are saying that we will pay after 1 month, we will pay after 2 months, we will pay after 3 months. So this big entity, it is giving the credit sale, it is doing the credit sale, it will get the money on a later on date. Okay, so it is getting many of the trade receivables. The banks can also do so, or the companies can directly do so. The companies can directly be involved in this process. Got it? Is this clear? So the originators can be the bank that is providing the loans. It can be the NBFCs that is providing the loans, or the banks and NBFCs that are involved in the trade receivables, or it can be the equipment leasing firms that are leasing the equipments. Okay, so they are involved in the equipment leasing receivables. So there are the equipment leasing receivables also. So the firm has given the equipment on lease, and the other entity is saying that we will pay. So let's say the equipment leasing firm has given the equipment on lease for the amount of 10 crores for a period of 2 years. Now the other entity is saying that we will pay the down payment, or we have paid the down payment of 1 crore, we will pay the 9 crore after 1 month. Okay, so there is the creation of equipment leasing receivable, that is 9 crore rupees has to be paid by this XYZ entity to this equipment leasing firm. So this is the equipment leasing receivable that the XYZ company will pay 9 crore rupees to the equipment leasing firm after 1 month. Okay, or there can be the other entities that are creating the trade receivables. So the corporates directly, let's say they have the bill invoices, so they are selling their bill invoices, or they are doing the securitization of their bill invoices. Okay, got it? Is this clear now? So these are the originators. Originators are the ones that have some assets, either in the form of loans or trade receivables, or they are going to receive the money in the future. Okay, this is the idea. So the loans and the receivables, they can be clubbed together in the form of securitized debt instrument. Now let's move forward. So originator, I hope you have understood, these are the assigner of the debt or receivables to a special purpose distinct entity for the purpose of securitization. Now coming to the next idea, that minimum ticket size and trade receivable. The trade receivable, basically it is that one entity is providing the product to the other entity and the other entity will pay after a period of time, let's say 1 month, 2 month, 3 month. So there is a bill invoice that is created that the ABC will pay 10 crore rupees to the XYZ after 2 months. So this is a bill invoice. This is a kind of trade receivable that the receipts or the payment has to be received for the trade. Trade receivable is nothing else. It is just the idea that the payment has to be received for the trade. That's it. Okay. So bill invoice or the trade receivable, this shows that the XYZ will receive the money. This shows that the XYZ will receive the money for the trade after a period of time. Now, if the XYZ wants the money right now, it can go to the banks to take the money right now, or it can like sell its trade receivables, or it can provide its trade receivables to the special purpose entity. Okay, so basically the originator, let's say it is a company. Let's say the originator is a company that is selling. So let's say originator is a company that is selling. So XYZ company that is selling all its trade receivables, that means the money that it is going to receive for its trade. So all its trade receivables it has sold to the SPV or the SPE, that is the special purpose entity. Special purpose entity is doing the securitization, is continuing the process of securitization and is converting these trade receivables in the securitized debt instruments that is sold to the investors, and the investors are paying for the trade receivables. Okay, and later on they will get some extra amount. So this is the basic idea. Okay, now coming to the next point, that the minimum ticket size for issuance. Now if you want to issue the securitized debt receipts, so if you want to issue the securitized debt instrument, the ticket size is the minimum investment, we can say. So securitized debt instrument जारी करने के लिए, issue करने के लिए, उसमें किए जाने वाले निवेश की न्यूनतम रकम, the minimum amount that has to be invested in the securitized debt receipt, in the securitized debt instrument to issue the instrument is 1 crore. That means the minimum ticket size or the minimum investment size for the issuance of a securitized debt instrument shall be 1 crore rupees. That means if you want to issue the securitized debt instrument, the minimum investment should be of 1 crore rupees. The minimum ticket size for subsequent transfers of a securitized debt instrument shall be as follows. So if subsequent transfers are happening, let's say you have bought the securitized debt instrument, now you want to transfer it to some other entity. So the minimum ticket size for subsequent transfers, for the transfers on a later on period of the securitized debt instrument should follow that for originators which are not regulated by the RBI. So originators which are not regulated by RBI. So originators are the ones that are the banks, NBFCs, as well as the equipment leasing firms, the corporates or the other entities. Okay, so banks and NBFCs, let's say they are regulated by RBI, but the equipment leasing firms, corporates, the real estate developers, they are not regulated by the Reserve Bank of India. Okay, real estate developers, they are not regulated by the Reserve Bank of India. So originators which are not regulated by the Reserve Bank of India, for them the minimum ticket size for the investment is 1 crore rupees. Okay, for the SDIs, for the securitized debt instruments having listed securities as underlying. So let's say there are the listed securities in the BSE, NSE. So in the stock exchanges, there are some listed securities that are clubbed together. They can also be clubbed together in the securitized debt instruments. Okay, so if there are the listed debt securities, they can also be clubbed in the securitized debt instrument. So basically, if for the securitized debt instrument that is having listed debt securities as underlying, the minimum ticket size amount shall be that of highest face value among such securities. So basically, let's say listed debt security, the face value, let's say there are 5 listed debt securities. 1, 2, 3, 4 and 5. So there are in total 5 listed debt securities that are clubbed together in this securitized debt investment. The first one has the value of 100 crores. The second one has the value of 20 crores. The third one has the value of 150 crores. The fourth one has the value of 30 crore. Fifth one has the value of 10 crore. So the highest 150 crores, or let's say this is 50 crores. Okay, let's say this is 10 crores and this is 35 crores. So the highest value is of 35 crores. The highest face value of the security that is present in this securitized debt instrument is of 35 crores. Okay, so the minimum investment size will be of 35 crores. So for SDI having listed debt securities as underlying, the minimum ticket size, the minimum investment size amount shall be that of highest face value among such securities, and the highest face value among such security was of rupees 35 crore, let's say. Okay, or rupees 35 or whatever the amount is. So this is the idea. So the situation is that initial issuance can only happen when the minimum ticket size shall mean the size of investment by a single investor. Okay, so this is the meaning of ticket size. Ticket size means the investment size that is done by a single investor. So for the initial issuance, of the securitized debt instrument, the minimum ticket size should be of 1 crore, okay. For the subsequent transfers for the non-RBI regulated originators like the equipment leasing firms, the corporates, the real estate developers and such, for them the minimum ticket size for the subsequent transfer should be 1 crore. Subsequent transfer, when we are talking about the securitized debt instrument in which there is the involvement of listed debt securities as underlying, so subsequent transfer of such securitized debt instrument can happen with a minimum ticket size of highest face value among those securities. So let's say in the securitized debt instrument there are 10 securities. So which security has the highest face value, that much investment should be done, that is the minimum ticket size. Okay. Now coming to the next point, the originator shall retain. Now till now I hope everything is clear. Now the originator shall retain a minimum of 10% of the book value of the debt or receivable being securitized, because let's say that XYZ company, this is selling some equipments to the ABC. Now ABC has said that I will pay 20 crores after 2 months. Okay, so this is a trade receivable that has been signed, that the XYZ will receive 20 crores for the trade after 2 months. Now this trade receivable is sold and multiple trade receivables are clubbed together in the form of securitized debt instrument, and this is sold to the investors through the special purpose entity. Now let's say that the XYZ entity has sold all its trade receivables to the investors. Now the XYZ will be free of mind that okay, ABC pays or not pays, we don't care now, because all the trade receivables have been sold to the investors and we have received the money. Let's say the trade receivable was of 20 crore and the XYZ has received 18 crores. 2 crores is the benefit for the investors. So the XYZ will think that okay, I have received the 18 crore rupees, now I don't care about the money. So maybe ABC is a fake entity, it is a paper company that runs away with the money. So it can create the problem for the investors and the trust also. So to not have this kind of problem and to make the entities also liable, to make the originators also involved in the situation, that's why there is a minimum investment or there is a minimum value that the originators have to remain in the total value. Okay, so originator shall retain a minimum of 10% of the book value of the debt or receivable. So if the receivable is of 20 crore, so 10% means 2 crore, this much of the value the XYZ should keep with itself. That means this is the money that cannot be raised from the investors. So that means now the investors are only paying 16 crore. 2 crore is the value that is kept with the XYZ and 2 crore is, let's say, the gain of the investors. So originator shall retain a minimum of 10% of the book value of the debt or receivable being securitized. So this much the originator has to keep. Okay. Next is provided that in cases where the scheduled maturity of any of the cash flows in the transaction is within 24 hours. That means that let's say the maturity of the securitized debt instrument. So in the securitized debt instruments, there are multiple loans, there are multiple different instruments, or there are multiple different loans under the securitized debt instrument. Under a single securitized debt instrument, it is a pool of loans, or it is a pool of receivables, okay, or it is a pool of loans and receivables combined. So in the securitized debt instrument, if the maturity of the securitized debt instrument is within 24 hours, or that means provided that in cases where the scheduled maturity of any of the cash flows in the transaction is within 24 months, the originator shall retain a minimum of 5% of the book value of the assets. So this is the basic idea. So here you can understand that the originator has to retain minimum of 10% of the book value of the debt or receivable being securitized. But if the maturity is within 24 months, the originator shall retain a minimum of 5% of the book value of the asset being securitized. Next is in case of residential mortgage backed securities. That means basically home loans that have the collateral that are backed by the homes, that are backed by the houses. So let's say I am taking a home loan, so my house is the collateral that can be sold if I am not able to pay back the money, right? So in the residential mortgage backed securities, the originator shall retain a minimum of 5% of the book value of the loans being securitized, irrespective of the original maturity, okay? So in the general case, the originator has to keep the minimum book value of 10%, and in case the maturity is within 24 months, so then the book value, 5% of the book value has to be kept by the originator. But in case of residential mortgage backed securities, only 5% is required. There is no 10% of the limit. Next is the loans are securitized by the originator only after completion of the minimum holding period. So the loan can be converted into the securities, or the loans can be converted into the securitized debt instrument only after completing the minimum holding period by the entity, okay, whoever is providing the loans, banks, NBFCs, or whoever is providing the loan, okay. So the minimum holding period for originator shall be 3 months in case the loans with tenure up to 2 years, or 6 months in case of loans with tenure of more than 2 months. So for 3 months, first the loan will be held by the entity itself. After that, it can be converted into the securitized debt instrument. Okay. So this is the basic idea that you can understand. So yes, if the maturity is within 24 hours, then 5% of the book value has to be kept. Okay. Public offer of securitized debt instrument shall remain open for not less than 2 working days and not more than 10 working days. So in between 2 to 10 days, the securitized debt instrument should be kept public. Okay. So if the securitized debt instruments are sold to the public, they shall remain open for not less than 2 working days and not more than 10 working days. This is the idea. Now next point is that the originator shall be able to repurchase the transferred exposure only through invocation of a cleanup call option. So what is a cleanup call option? First, let's understand this. So in the cleanup call option, this is an option in securitization transactions in the securitized debt instruments in which the issuer, that is the originator we can say, may reduce its own administrative expenses by buying back the remaining issue when the principal has been reduced to an insignificant amount. Let's say the loan was of 20 crores. Now the 18 crores has been paid back by the borrower. Now only 2 crore is left, or let's say only 1.5 crore is left with the borrower. Now it is very hectic for the originator, that is the bank. Let's say in this case, the bank has given the loan of 20 crores, out of which it has received back 18 crores from the borrower. Now only 1.5 crores or 2 crores is left with the borrower. Okay. So now it is very hectic for the bank to continue this securitized debt instrument through the special purpose entity, because the money has to be again and again, the bank is receiving the money from the borrower. It has to transfer the part of the interest to the investors, or it has to provide the money to the investors also, because they have invested in this loan. indirectly through the securitized debt instrument. So this is a very hectic process and it is costing a lot to the bank to maintain the administrative expenses to continue this process. So now it is said that the banks or the originators can have a cleanup option when the remaining issue, when the remaining amount or the remaining issue, we can say the remaining amount is very negligible. When the remaining amount in the securitized debt instrument or the remaining amount of the loan is very less, in that case, the callback option can happen. Okay. So this is an option in securitization transaction in which the issuer, that is the originator, may reduce its own administrative expenses by buying back the remaining issue when the principal has been reduced, when the main amount has been reduced to an insignificant amount, usually less than 10% of the original issue. So the securitized debt instrument was worth 200 crores. Okay. Now most of the payment has already been made. Let's say only 20 crores is left. Only 20 crores is left, or only 18 crore of the amount is left. So in this case, the bank will directly pay to the investors and will continue the operations by itself. Okay. So this is the idea through which it will reduce, the bank will reduce its administrative expenses as it will not have to continue the whole of the process. So the original shall be able to repurchase the transferred exposure only through invocation of a cleanup call option. The originator can exercise the cleanup call at the threshold of not more than 10% of the original value. So basically, for the securitized debt instrument, if it has to be recalled, if it has to be bought back, that can only happen when only around 10% of the value is left of the securitized debt instrument. Okay, and the rest has already been covered. So permissible underlying assets. So this is clear. Now the permissible underlying assets in the securitized debt instruments now includes listed debt securities. So listed debt securities can be clubbed together under the securitized debt instrument. Accepted trade receivables, that is the trade receivables that is accepted by the buyer also. So the buyer is agreeing the ABC. So in the case of trade receivables, there is a seller XYZ and there is the buyer, that is ABC. So ABC, that is the buyer, is agreeing to the trade receivable that yes, I have to pay 20 crore rupees to the XYZ and I will pay it after 2 months. So this is a trade receivable. That is the money the XYZ will receive after 2 months. So the buyer has agreed that yes, I'm going to pay this much. Okay. So accepted trade receivables can be clubbed together in the securitized debt instrument. Rental receivables, okay, that rent will come. So in the case of real estate developers, they develop the big estates and they develop the big colonies and the big buildings, okay, from which they are going to continue to receive the rents. Okay, so rent receivables can also be clubbed together in the form of securitized debt instrument. So let's say that the real estate developers, they are going to receive, let's say 10 crore rupees on the monthly basis from the real estate, okay, from the buildings. Okay, now the real estate developers, they want to get the money, that is 100 crore rupees they want to get. So the rent receivables that they are showing that they have 10 buildings. Through that 10 buildings, they will receive the rent of 10 crores per month. So they are saying that this rent receipts are converted into the securitized debt instruments that are sold to the investors, and investors are giving 100 crore rupees to the real estate developer so that the real estate developer can make further buildings also. Okay. Now the investors on the regular basis, they are getting monthly, let's say 8 crore rupees they are getting. Okay. And they will also get some interest or they will also get some extra returns. So investors will get this 8 crore rupees, let's say for 20 months. So you can understand that it will be a huge profit for investors because they have given 100 crore rupees, but they are getting 8 crore rupees for 20 months. That means they are getting 160 crore rupees. So that's why the investors also get involved in the securitized debt instruments. Understanding the point, I hope this is very much clear that the real estate developer knows that it will receive 10 crore rupees on the per month basis from its buildings through the rent. Okay. So, but it wants currently, immediately it wants 100 crore rupees. So it will, through the special vehicle, through the special purpose entity, it will release the securitized debt instrument, okay, that will transfer the rent receivables to the investors. Okay, so investors will receive, let's say 8 crore rupees on the monthly basis. and for 20 months it is said that they will receive the money if they provide 100 crore rupees immediately to the real estate developer. So this is the kind of process that happens. This happens in various ways, okay? So this is the idea. So permissible underlying assets are listed debt securities, accepted trade receivables, rental receivables, as well as equipment leasing receivables also. For the equipments also the same process goes on. Now for the RBI and for the regulated entities, what is the idea that we will understand? So if any financial asset originated by an originator regulated by the Reserve Bank of India can be securitized, can be converted into the securitized debt instrument, but there are some exceptions. So first of all, any financial asset that is originated by the originator, by the regulated entity under the Reserve Bank of India, they can be securitized, but special purpose distinct entity shall ensure that such originators that are regulated by the Reserve Bank of India shall not undertake the securitization activities or assume securitization exposure mentioned below. So securitization cannot happen in this in these areas, that is re-securitization exposure. Re-securitization cannot happen. Re-securitization means securitizing the securitized debt instruments. So securitized debt instruments consist of various loans or various trade receivables that are securitized and converted into securitized debt instrument. So various loans, various receivables are converted into securitized debt instrument. Okay. Now various securitized debt instruments are converted into the securitized debt instrument. So that is re-securitization, securitizing the securitized debt instrument. So that is complicating the process, and many of the investors might get confused in this, as well as this can create the problem of the liability that it can fail later on. Okay. If the lower loans are failing, the securitized debt instrument will fail. If the loans are not coming back, basically this securitized debt instrument will fail. The investors will lose the money. Now let's say that this securitized debt instrument was further collected under the further securitized debt instrument. So this will also fail and more investors will face the problem. So re-securitization should not be done by the regulated entities of the RBI. This is the basic idea. Next is that structures in which short-term instruments such as commercial papers are issued against long-term assets. So this should also not happen. The short-term assets, like various short-term assets, should not be converted or should not be issued against the long-term instruments. Okay. Synthetic securitization should not happen. Synthetic securitization is when a company uses financial agreements to share the risk of the loan with the investors, but the actual loan assets are not shared with the investors. Okay. So in the securitization, what happens? In the securitization or in the securitized debt instruments, the loans are transferred to the securitized debt instruments which are sold to the investors. So in a way, the loans or the receivables are directly sold to the investors, or a part of the loan and receivables are sold to the investors. But in the synthetic securitization, only the risk is transferred to the investors and only the part of the profit or returns are transferred to the investors. The loans are not actually transferred, and in the loans are still shown in the book value of the entities. So this is synthetic securitization, that without transferring the actual loans, without transferring the actual receivables, there is only synthetic securitization that is happening. That is a way of cheating, we can say. Okay. So synthetic securitization has not been allowed by the RBI basically. Next is securitization with the following assets. So revolving credit facilities, if the banks are providing the revolving credit facility through the credit cards, because what happens that you have a credit card limit now of let's say 1 lakh rupees. So you have used 50,000 rupees. So you have the left out limit of 50,000 rupees. Okay. Now you have to pay it, and in the later on month, you can again use the 1 lakh credit facility. So this is the revolving credit. That you keeps on taking the money, you keep on paying it back. You keep on taking the money, you keep paying it back. So this kind of revolving credit facility cannot be converted into the securitized debt instrument. That is the idea. Restructured loans and advances cannot be converted into the securitized debt instrument, because restructuring usually happens when the borrowers are unable to pay. That's why the loans and advances are restructured. So in the restructured loans and advances, securitization is not allowed. In the refinancing exposures of all India financial institutions, the securitization is not allowed. Exposure to other lending institutions, let's say bank is giving loan or NBFC is giving loan to other NBFCs or other banks. So exposure to other lending institutions, in this case also securitization cannot happen. Okay. Now loans with residual maturity of less than 365 days. In this case also securitization cannot happen, provided that these norms are being met. Okay. Till now any confusion? Till now any confusion? So in this case, in the case of re-securitization, in case where the short-term assets are issued against the long-term asset, or in case of synthetic securitization, in case of revolving credit, in case of refinancing or restructuring, in case of loan exposures to other lending institutions, in these cases securitization cannot happen, and the special purpose entity has to ensure that such originators or the originators under the RBI shall not undertake the securitization in these activities. As well as loans with residual maturity of less than 365 days. So if loans have less than residual maturity of this much, then also securitization cannot happen, but provided that loans with tenure up to 24 months, the loans with tenure up to 24 months extended to individuals for agricultural activities under the priority sector guidelines or under the priority sector lending, where both interest and principal are due only on maturity. That means principal and interest will only be taken on the maturity. Before that, the principal and interest will not be taken. So such kind of loans can be securitized. Such kind of loans can be securitized. Okay. So this is the idea. Okay. Now trade receivables with tenure up to 12 months. Trade receivables with tenure up to 12 months discounted or purchased by lenders from their borrowers, this shall be eligible for securitization. So basically loans with residual maturity of less than 365 days, this shall not be allowed for securitization, provided that loans with tenure up to 24 months extended to individuals for agricultural activities, this should be allowed for securitization. With the receivables with tenure up to 12 months, this should be allowed for the securitization. As well as provided further that only those loans or receivables shall be eligible for securitization where a borrower in the case of agricultural loans or a drawee of the bill, that is in the case of trade receivables, has fully repaid the entire amount of the last two loans or receivables within 90 days of the due date. So basically the idea is that the loans provided by the regulated entities under the RBI shall not be securitized if the residual maturity is only 365 days. But in the case of agricultural loans that have the maturity or that have the tenure up to 24 months, or in the case of receivables, trade receivables under the regulated entities that have the maturity of 12 months, they are allowed to be securitized. But in this case also, it has to be seen that the people or the individuals that had taken the agricultural loans in the past 2 times, have they paid it back within 90 days of the due date. So this is the basic idea. Okay. So this is it. Now the last 2 points we have to discuss. First of all, financial information concerning the originator's assets and liabilities. So you need to have the financial information about the originator, that which is the corporate, which is the equipment leasing company, or which is the real estate developer that is selling its trade receivables, that is selling its rental receivables and such. Because when you have information about the entity, let's say there is a big real estate developer that is selling its rent receivables. So you will trust this real estate developer, that is a very NAMI or that is a very established real estate developer, and you will buy the securitized debt instruments that is sold by this originator through the special purpose entity. So you need to have the information about the originator's assets, liabilities, financial position, profits, losses, for the purpose of which the originator shall provide a complete audited financial statement for past 3 years, and if necessary unaudited financial statement prepared within 120 days from the date of the application. Okay. All the securitized debt instruments are now required to be issued and transferred only in the dematerialized form and not in the physical form. So this is all. Any confusion? So moving forward with the next news article, very basic news article. Basically, public sector banks total cumulative profit has increased to a record level of rupees 1.78 lakh crores in the financial year 2024-2025. So in the financial year 2024-25, the cumulative profit of the public sector banks have increased to a record level of rupees 1.78 lakh crore. All 12 public sector banks had earned a total profit of rupees 1.41 lakh crore in the previous year, and in the previous financial year of 2023-24. So from the 2023-24 to 2024-25, there is an increase in the profit by 26%. So the profits have grown by 26%. Out of the total profit of rupees 1,78,364 crores, the big chunk, 40% of the total earnings was of the State Bank of India. So State Bank of India alone contributed over 40% of the total earnings of all the banks combined. Okay, SBI logged a net profit of 70,901 crores. Okay, that is 16% higher than the previous financial year. Now, in the percentage terms, the Punjab National Bank has reported the highest net profit growth of 102%. That is a huge increase. So in the amount terms, the State Bank of India has gained the maximum profit. But in the percentage terms, the highest growth in the profit has been seen by the Punjab National Bank. Okay. Now the banking sector's turnaround from a cumulative. Now there was a total loss of 85,390 crores in the financial year 2017-2018. Now this cumulative loss has turned into the record highest profits ever in the financial year 2024-2025. This is attributed to the reforms and initiatives taken by the central government. So if we see the financial year 2017 to 2018 and we compare it with the financial year 2024-2025, so there was net loss that was seen in the financial year 2018, which has converted into the net profit or the huge record profit in the financial year 2025. Okay. Now the doom to bloom story of the public sector banking industry can be attributed to the initiatives and the steps taken by the central government. There was the 4R strategy that was adopted by the government, that was recognizing the non-performing assets transparently, because when we recognize it, then we can work on it, right? When we recognize our problems, our weaknesses, then only we can work on it. So recognize the NPAs transparently, resolution and recovery of the money, how it can be resolved, how it can be recovered, whatever amount that can be recovered should be recovered, recapitalizing the public sector banks, providing the capital to the public sector banks so that they can work smoothly. So government provided capital to the public sector banks, reforms in the financial ecosystem so that they can work in the efficient manner. The governance was improved of the public sector banks. Okay, in the case, various public sector banks have posted significant profit jumps. Central Bank of India, UCO Bank, Bank of India, these have recorded more than 40% increase in their profits. So more than 40% of the growth in profits they have seen. Okay, so they have seen a lot of jump in the profits. So this is it for today. Thank you very much for joining the session. Now I will show you the homework questions that you have to answer in the comment section below. So this is the first question. I hope you will be easily able to answer this question. So do try to answer this question and give me the right answer, okay? And this is the second question. Try to answer this question also. So I hope you will be easily able to answer this question also. Now this is it. Thank you very much for joining the session. Do give me the right answer of the homework questions, and if you have any query, you can comment down below. Do comment down below, okay? So thank you everyone. Thank you for joining. I hope everything is fine. Everything is clear. Thank you everyone. Thank you for joining. See you in the next session.